Thanks for joining me today for our Signature FD weekly investment audio cast that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So let's go ahead and kick things off with a look at the Atlanta Fed GDP Now calculation. And we show that here in red. Now, this chart also shows the Citigroup Economic Surprise Index in blue. And what we can notice is that economic data has been turning higher following a negative first quarter. We see that both in the Atlanta Fed's tracker as well as the economic surprises. These are good developments that tell us that a lot of the Q1 weakness was probably related to trade and that underlying trends in economic growth do appear positive. Now, while the economy is tracking a decent second quarter bounce back, we're also cognizant that there could be a soft patch here in upcoming months, as there was a lot of tariff front running in the activity, and that appears to be easing. So, three examples are shown here in this chart. We're showing the monthly changes in durable goods orders, non defense capital goods ex aircraft orders, and pending home sales. All three series gained in March and then fell in April. Monthly changes are lumpy in this data, but it does illustrate that trade policy has created some volatility in economic activity. We'd also note that initial jobless claims did tick higher last week, and workers are reporting more difficulty in finding new jobs. So there are some cracks in the economy. Now, much of this really does come down to policy uncertainty. This chart here shows CEO confidence, and we can see a record monthly plunge in this data series. Our base case has been that underlying economic activity is solid and can remain so as long as the policy mix becomes more clear. However, historically, weak CEO confidence has been a leading indicator of weak hiring and business investment. Now, it would be a great start here if we were to get some policy resolutions here in the upcoming weeks and maybe a few short months. Now, one of the challenges that the economy faces is restrictive policy rates. There's been an extended pause in the Fed cutting cycle this year, and again, uncertainty is their word du jour as well. But inflation has been coming in fairly benign lately. Here in orange, we can see that the PCE price index is up 2.1% over the last year. Now, some more good news on inflation could see the Fed resume their rate cut cycle. As long as the economy is expanding, rate cuts have been a good condition for the stock market. Currently, the market is pricing in a very slim chance of a cut here in June, but a little more economic softening and easier inflation numbers could align with a resumption of the cutting cycle relatively soon in order to get to a more neutral policy setting. Now, just to reiterate, the key issue is the persistence of uncertainty. This chart in orange is showing the economic policy uncertainty index, and we can see the current extreme levels. Historically, elevated uncertainty has resulted in weaker economic growth. So, if the economic growth is easing, we would expect some asset classes to perform better than others in that environment. One example would be the stocks of companies that have been growing their dividends. Dividend growth is something of a high quality marker for a company. So, it probably makes sense that companies that have been growing their dividend have outperformed when economic growth has been relatively weak. And that's all we're showing in this chart. Now, Signature FD clients do have exposure to high dividend growth companies. Now, one last point for today. Retail gas prices have been easing. Lower gas prices could be a positive catalyst to improve consumer sentiment. This chart compares gas prices adjusted for broad inflation to consumer expectations for future inflation. There's a tight relationship here, so if gas prices remain contained or even fall, that could help boost consumer sentiment as the year goes on. So, as usual, we'll wrap things up here with a look at year to date returns for select asset classes. Now, after a rally last week, US large cap stocks are now positive on the year. Small caps remain negative, but they've come back a bit here recently as well. International stocks remain market leaders on the year, and we continue to think global diversification makes sense in 2025. So, our closing thoughts for this week are that the economy is somewhat lumpy right now given trade policy uncertainty. Some positive catalysts as the year progresses could be lower interest rates and lower gas prices, and that could help to boost consumer sentiment. Now, diversification has been a theme of this year, and also quality remains a theme when there's elevated uncertainty and potentially slowing economic growth. And we have both of those themes expressed in client portfolios. So, as always, I want to thank everybody for joining us today, and I wish you all a great week ahead.